Warren Buffett once said, if he could only know one number about a business, this might be the one. Not revenue. Not profit. Not the stock price. One ratio that tells you how good a company really is at turning your money into more money. I've spent 50 years watching investors chase the wrong numbers. They obsess over earnings growth. They fall in love with a rising chart. And they miss the engine underneath it all. Return on equity (ROE) measures how much profit a company squeezes out of every dollar shareholders have put in. It's the closest thing we have to a report card for management. But here's the catch: a high ROE can mean brilliance. Or it can mean a company one bad quarter away from collapse. By the end of this, you'll know which is which. Let's make this real. Imagine you hand a manager $100 to run a lemonade stand. At year's end, they hand you back $15 in profit. That's a 15% return on equity. Hand it to a better operator, and they turn that same $100 into $25. Same capital. Very different engine. So what's a good number? As a rough guide, an ROE consistently above 15%, year after year, signals a genuinely strong business. The word that matters there is consistently. Any company can post one great year. The great ones do it for a decade. But raw numbers lie without context. And to see how, we need to open up the engine. Back in the 1920s, an executive at the DuPont Corporation figured out something clever. ROE isn't one thing. It's three things multiplied together. Profit margin, how much you keep from each sale. Asset turnover, how efficiently you use what you own. And financial leverage, how much debt you're piling on top. This matters enormously. Because two companies can show the exact same 20% ROE for completely opposite reasons. One earns it through fat margins and smart operations. The other borrows heavily and juices the number with debt. Same score. One's a fortress. One's a house of cards. And that difference is exactly what wrecked one of the most famous firms in history. September 2008. Lehman Brothers collapses. It was the largest bankruptcy in American history. And here's what almost nobody noticed: in the years before, Lehman's return on equity looked fantastic. Strong, double-digit returns. Investors loved it. But that ROE wasn't built on great business. It was built on leverage, borrowing roughly $30 for every $1 of real equity. When you borrow that aggressively, even a modest profit looks spectacular against your thin sliver of equity. Until the assets drop just a few percent, and the whole thing is wiped out. That's the danger. Leverage doesn't just amplify your gains. It amplifies your funeral. So how do you spot the real thing? Compare it against something built the right way. In 1972, Buffett bought Candies for $25 million. The business needed only about $8 million of capital to run. And it earned around $4 to $5 million pre-tax that first year. That's a monster return on the capital employed. Even better, C's barely needed new money to grow. Over the following decades, it sent well over $1 billion in profit back to Berkshire while requiring almost no additional investment. That's the dream high ROE that doesn't eat cash to keep going. Now look at Apple today. In recent years, Apple's ROE has run above 150%. Sounds impossible, right? Part of it is a genuinely spectacular business, huge margins, a powerful moat. But part of it is that Apple has bought back so much of its own stock that its shareholder equity has shrunk dramatically. Fewer dollars in the denominator, a bigger looking ratio. Neither is wrong. But you can't understand either one until you look under the hood. Here's the one principle to carry with you. Return on equity tells you how good a company is at turning your dollars into more dollars, but only once you know where that number comes from. High ROE from durable margins and efficiency? That's a wealth machine. High ROE from a mountain of debt? That's a countdown clock. Don't just ask how high. Ask why. So here's my question for you. What's a company you own, and do you actually know its return on equity? Drop the ticker in the comments, and let's break one down together. If this changed how you read a balance sheet, hit subscribe. We do this every single day. And remember, this is educational content, not financial advice. Always do your own research. Tomorrow, we're tackling the number Buffett trusts even more than this one.